Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thank you for joining me. As you can see, Josh is out today. He's actually out this week on a well-earned vacation. So today I thought I'd talk a little bit about inflation. We've seen lots of inflation data over the last couple of weeks, including this morning, and market volatility. But before we talk about that, I do want to address some of the phone calls and emails we've been getting based on our last two e-news and people taking it as you should be making dramatic changes to your money. Now, first I want to say that the only thing that should cause you to make a change or have us make a change to your portfolio is your life circumstances. We don't want to be doing anything based on what the market is doing in your account. We want to be making changes based on your life circumstances, because that's really the only thing we can kind of control is our life circumstances, not what the market is doing. And so that's first and foremost. And remember, investing is not a binary decision. So we've talked in the past about you should be expecting volatility, and we still believe that, but it's not a binary decision where we're going to be all in or all out. You can make adjustments to your portfolio where you're either adding risk or taking risk away, but we don't want to make wholesale changes to our portfolio based on what may or may not happen. And so I think that's the takeaway I want you to get from this, is that yes, we can be tweaking your portfolios from a risk perspective, but we never ever think that people should be making binary investment decisions where they're all in or all out of the market. And I think the last two e-news, that's what people got from those, and that's certainly not the message we wanted to convey. So let's talk about inflation. Obviously, last week we got the CPI print that was 5% year over year. This morning we got the producer price index, which was 6.6% higher year over year, the highest since they've been keeping track of that since going back to 2010. So it's clear that inflation is in the U.S. economy. The Federal Reserve continues to say that it's going to be transitory. I happen to disagree with them. I know Josh does too. One of the reasons for that is when you see wages increasing as much as they have. So in places like Bend, Oregon, there's a McDonald's right down the street here where they're advertising on a billboard out front of the McDonald's for $17.50 starting wage. We know dishwashers in downtown Bend are making $20 an hour, and in Sun River, the maids are making $25 an hour to start. So we're seeing dramatic increases in wages, and when you increase wages like that, it's very hard to roll that increase back. And so we may see wage price inflation in the system. I think certainly we haven't seen meaningful inflation over the last 20 years, and I think now, because a lot of the things that have been going on from the U.S. Treasury and the Federal Reserve, we are going to see higher inflation. It doesn't mean we're going back to the 1970s style inflation. They were doing a lot of things back then that didn't make any sense. Remember, we have a lot of deflationary forces in globalization plus technology. Technology has been a huge deflationary force. So while I do think we're going to see higher inflation, I don't think it's going to look like the 70s. So what does that mean? Well, the Fed, I think, is beginning to talk about the unraveling of all of this stimulus that they've been providing the U.S. economy. So they're continuing to buy $120 billion worth of bonds every single month. And I think when they meet in August in Jackson Hole, late July, early August in Jackson Hole, they'll probably talk about tapering that purchases of bonds. And then the next step after that will be for them to have to raise interest rates. Because I think the U.S. economy overheating and inflation starting to come back is going to force the Fed's hand. And so that probably means volatility for the stock market. And deservedly so. I mean, we haven't had meaningful volatility since March of 2020. And so I'm bringing this up because we want you to mentally prepare for some volatility in the stock market. Again, that doesn't mean you should be making some all-in or all-out decision. Just know you should expect it. It's going to come. And remember, the one thing all bear markets have in common is that they all end. And so, even if you had invested at the peak of the market in 2007, right before the financial crisis, if you stayed invested through all that, you were obviously way, way ahead of where you would have been if you tried to time that market. Remember, it's time in the market, not timing the market, which will lead to successful investing. So, if you want to talk about your situation and your asset allocation, you can certainly call the office and we can schedule an appointment and talk about it. But what I really want you to get for this is you should expect volatility, but that doesn't mean you should be making some dramatic change to your portfolio. So if you have questions about your situation, call the office, 800-743-0988, and we'll see you back here in 2 weeks.